Hello and welcome to Options Guide TV. My name is Brian Overby. I will be your host on Options Guide TV for about the next 25 minutes or so. If you've been under a rock recently, you probably didn't know that Nvidia actually announced earnings. And guess what? They blew away the numbers again, and the marketplace rewarded them by beating up their stock. So Nvidia, we did in my mind, we did a perfect trade on Wednesday's show ahead of their earnings. And I billed it as a FOMO trade in NVIDIA. And I've used this strategy before, and I've had other people always ask, like, okay, we're going into NVIDIA. It's actually been the best stock out of all the tech stocks in the marketplace this year, up 160 some percent. I'm nervous, but I want to participate in NVIDIA. How can I do that? And the way I looked at it is, to me, you're telling me you wouldn't mind buying the stock. You just don't want to buy it and then have the stock go down, which is exactly what it did, even though they had great numbers. They literally the only thing that NVIDIA, I guess that you could say would be a downside, was they actually couldn't keep up with the orders. That's about the only thing that you could say that was bad about NVIDIA's earnings, but people took this opportunity to sell off the stock. Now, NVIDIA's been lower recently. You had an opportunity to buy it below 100, like even below where the stock split at after it did its 10-for-1 stock split. So for a minute, it traded between 90 and 100 on one day, but then it took off as soon as that day ended, and it closed above 100, and now it ran all the way up to 124, and now we're back. So here's where the story is. We went in and we sold a put to pay for an out-of-the-money call. Our out-of-the-money call is still alive because we sold the put in the first expiration, and we are long the call in the September 6th expiration. So I'm not going to go to the software just yet, but the concept was, well, I'm telling myself I want to buy NVIDIA, but I'm nervous about the earnings. But what if the stock takes off, which has happened many times with that company and announcing earnings? So we sold a put and said, if it comes down, let's buy that stock. Cash secured. The stock, it was at a price of 109 is what we were looking at. Stock never got down to that level, but 109 was the strike that we were looking at. And then we went out and said, we're going to go out of the money on the call side, and we're going to use that cash to help pay for that call. So on that side, we ended up paying $1 for the entire trade. And now the market is literally right in the middle. So we're going to lose that $1. So it did cost us, and the stock didn't come down low enough that we're going to actually buy it. So I leave the call in there, just let that ride and buy the stock. That simple. You got the opportunity to buy it at a lower price. So let's run to the Tradier Pro software right now. And we're going to actually look at the chart in NVIDIA. 1 second. Let me get that a little bit set up. And we'll zoom in over here on this corner. Right in here. Okay, so you could say, and you could make this argument, that if you had bought NVIDIA, you'd be really sad right now, right? Because the stock was trading somewhere around 124, 125 on that day, and then the market now is at 118. So we paid $1. We still got a call that's alive, so there's still a chance that it could run up to the 130 level. There's a chance. But it allowed us to get into the trade without buying NVIDIA ahead of earnings. It gave us literally the fear of missing out, saying that if it comes down, I'll buy some. But if it goes up, I don't want to miss out on the huge explosive moves that NVIDIA has had after earnings. So I think the trade functioned. We did lose $1 on it because, we could have sold the same sold the front expiration and bought the call in the front expiration, and we would have had get that done for about even. But I liked having a little bit more time on the long call option. So That was our trade in NVIDIA. To me, it worked out because now you're buying the stock about 7 points lower than if you had bought it before, but you paid $1 for the fear of missing out trade. That is my take on it. But and this is always those things where people come in and they always say, 80% of option traders lose money or something like that. And these are just misnomers all the time. But it's really hard to say, well, did we lose money on that trade? Right? We wanted to buy NVIDIA. We lost $1, but we're buying NVIDIA now 7 points below where it was if we had bought it before earnings. So the trade allowed us to do that and not be nervous about it. So to me, we're up $6 on it. We lost $1 on our trade, but we bought the stock 7 points or 6 points lower, 7 points lower. So do the math and you come up with $6. That's the way that I would approach NVIDIA. Now, I have NVIDIA in my account, and at this stage, we're going into September and October. It'll be interesting to see if the marketplace does what it has done over time. I had Russell Rhodes, Professor Rhodes, on the show on Monday, who is the king of the VIX options. It's written more books on the VIX than anyone. And we talked about the seasonality of the VIX and the fact that September and October are usually very volatile months. And that usually is caused by the fact that there's at least 1 or 2 big downturns in September or October. What we've seen in the market, though, is saying it's going to be really hard for the market to give up some of those gains, mainly because we had decent numbers in the PCE. The Fed, there's a 100% chance that they're going to cut rates. There's a 30% chance they might even cut it by 50 basis points. But with the numbers today, it's almost a certainty that on September 18th, the Fed will cut rates at least 25 basis points. They're saying there's a 70% chance of that, and there's a 30% chance of them cutting 50 basis points on the Fed's funds rate. The earnings season has been solid. We're seeing the Russell 2000 index actually pick up some steam because people are feeling good about the markets and the fact that interest rates are going lower. So there's a lot of good news going into September, not to mention the fact that we already had one little downturn in August, that was a big surprise to me. Okay, so with that said, I still went out on Wednesday, and I'm going to trust the seasonality of the VIX. And I did a very inexpensive modified butterfly. And I did that fairly large in my own account. And that's probably one of the scary things because I really like the trade. And so that always makes you nervous. And the nervousness is the strong earnings, the decent economic data, and the Fed will be cutting in the middle of the month, right? Well, 99% chance that they're going to cut in the middle of the month. I don't want to say 100% chance. All right. So on my current position, and I'm going to, let's move out a little bit. Let's move out. And I bought NVIDIA in chunks. So let's go to the just me screen. All right. Thank you. And then I'm going to pull up the options playbook. And I'm going to show you a trade that I really don't talk about a lot. And as always, I look for opportunities to bring up. There's over 40 different strategies inside the options playbook. And I do specifically, especially on this show, look for times where I can apply these strategies. So it's not always that it's a staple in a portfolio, but I want to show the versatility of options just in general. Okay, so let's run to options playbook. And you see here, we have a front spread with calls, also known as a ratio spread. And in this instance, this is a scary trade. You are buying strike A and you are selling 2 of strike B. So over here, you buy a call at strike A, you sell 2 of strike B. This means that you are naked a call option. So I very rarely talk about this trade because, especially on Options Guide TV, I don't like to present to retail customers, which are most of the people that watch this show, trades where you have an unlimited risk to the upside. You got to you got to understand margin. You got to understand a lot of things. So most of our trades have limited and known risk that I talk about on the show. This trade can have limited and known risk. And if you've ever done a covered call on an underlying stock, and I just actually saw a pundit on a show talk about selling covered calls going into earnings on Nvidia, and I hate that trade. I hate the fact that you would limit your upside on a stock like that and have all the downside. I don't like that ahead of earnings, and I thought it was a horrible trade. And of course, that person was bragging about it because Nvidia went down and it got a lot of premium on it. I would rather do it after the fact. And if I was going to do it, what I'm going to do is covered call on steroids is the way I look at it, in that we won't bring in as much premium, but we're going to give ourselves some upside. So if you take this trade and you see here, we are long a call, just one call at strike A inside the playbook, the setup is. And then we're going to sell 2 calls at strike B. Well, if we own the stock, we're not naked anymore. That changes the whole dynamic of the trade. We still get this little bump up on the upside, and we still get a small net credit on this side. So we have the upside. We're going to receive a credit. We're still going to have a small buffer to land on. I like that there's more certainty now in the stock, that it's already announced earnings. I don't have to worry as much about the stock just blowing away and going up 100 points, which Nvidia has done after earnings, or almost, I should say it a different way, that and the stock price doubled after earnings, because Nvidia has done that a few times on its ride up to the leading the market in a percentage gain for the year. All right, so let's go back and we're going to run back out. Keep in mind this graph, okay? And we're going to run back out and we're going to look inside the Tradier Pro software. And remember, I'm going, in my account, I have hundreds of shares of Nvidia. I've put the position on slowly, and even bought at one point in time a deep in the money long-term call option, okay? Now, so the concept is that you have 100 shares of stock of Nvidia. You have to remember that you have 100 shares of stock. And that makes this trade and the profit and loss quite a bit different. But we're going to do it as of today, mainly because there's no positions in this test account. And we're going to go out 14 days. So we're going to go into the September meeting ahead of that Fed meeting. And we are going to then start by selling a call option that is going to pay for our out of the money option contracts. So when we do this, we're going to sell. Let's look at we're okay with not going at least a standard deviation out of the money, because we want some upside on this trade. So if I look at selling something that's within the 1 standard deviation move, which the Tradier Pro software does a great job of highlighting a 1 standard deviation move, which means that your 129, 130, the delta should be somewhere between 16 and 20, somewhere within that range. The 130 right now, it's highlighting at a 17 delta. So we're right about a 1 standard deviation move, right at that 130. So that happens 16% of the time. That's what the concept is. All right. So in here, we are going to sell the 1.8. We're going to sell the 125. We're going to sell this option contract. And then we're going to use those monies. We're not going to be able to get much on that one. Let's do it, though, this way. This is what I was looking at earlier. So now this is done for a small net. Well, this is done for even right now. Let's move down a little bit and try to get a small net credit to the account. So we're going to go up to 14 days. Let's go down to this contract. We're going to sell the 124. And we will, and then we'll do 6 points, and then we'll buy this one. Okay. All right. So If we look at this, now we're bringing in a small net credit of 30 cents to the account. Let's send this to the what if calculator. And you'll see something that looks very similar. Gotta flip that script. Okay. All right. Let me go back and change this up. 1 second. So that's why so we are going to buy this one and then sell that one. Okay. So let's buy here. Sell 2 of these. All right. And then send that to the what if calculator. So there's our 30-cent net credit to the account. And we pull this down. We got the market here. We, on the upside, if this goes all the way up, the difference between the strikes is $4, 125 to 129. So we're talking about $4 on this trade. So that is our upside. We could add $4. Basically, we're going to add 100 shares of stock from this strike from 125 to 129. So that adds 100 shares from that range. Now, if it goes all the way down, well, we still own the stock, but we have the issue in that they could take away our 100 shares because we sold in this scenario 2 option contracts that were out of the money to pay for the one that's in the money in that scenario. So if we look at this trade and we let's go back to the trading tab and we sell this trade overall, what will end up happening on the chart, which I wanted to. All right, there it is. So now in this scenario, that's where I wanted to add the equity. So this is saying that we bought stock at this level. So now in our position, it is saying that we have 100 shares of NVIDIA. We are long 1 call option and we are short 2 call options. So on the way up, if we go all the way back to where we started before the earnings, right at the 125, 126 level, somewhere in there is where the stock was before that earnings announcement. From 125 on up, it's like we are leveraged on our stock, like we margined our stock. So from that range, rise over run, for every point it goes up, we're going to make 2 points on our portfolio until we get to here at 129. And then from 129 on up, we are in danger of losing our stock. So we have to decide what's going to happen if it gets up to this position. If you don't want to lose the stock, we'd have to roll that 1 call that is covering our stock. But remember, we just made, what's the range here? $4, I think. We just made $4 on our long call spread that goes along with this. So to me, this is a covered call on steroids. You're not bringing in the money that you would if you sold the call outright. So let me run back to this side here. I apologize for being disjointed on this. But if I look at this, if I had just sold the 129 strike call, right, I would, if I just sold the 129 strike call, I'd be bringing in $1.12. $1.12. I have 100 shares of stock. That's $112. I do this trade. I'm bringing in 30 cents, $30 on the trade. It's a third of what I would if I just sold that option outright. But if the market goes down, I still can get that 30 cents. If the market goes down on my covered call, I get my $1.13. That's the way that would work. But on the upside, I can now make $4. I'm still covered on the position, but I got that potential to make $4 if this underlying bounces back within the next 14 days. I'm in the position. To me, I'd much rather do this trade on a stock like NVIDIA than just a normal covered call. If just the flat out upside of NVIDIA and the volatility of the underlying stock makes this a much more interesting trade. If I'm selling Walmart, maybe I just sell the call. That's fine. I'm not as worried about the stock shooting up and getting the stock taken away, right? In this instance, if it shoots up, that's great. I might have to buy this back at a loss or roll it out on my 100 shares. I might have to do something with that trade to prevent assignment, but I would have had to do that on the covered call anyways, right? But in this instance, I have money to do that now. So I haven't talked about this trade. I haven't really seen an opportunity like this one. The stock is down. We were trying to buy an extra 100 shares with our FOMO trade. That trade didn't necessarily work out, I guess is a way to say it. But now that we're back in this saddle and we're long 100 shares of stock going into September and October, kind of scary months, this is an interesting way to place that trade. You got the 100 shares. You're not quite as worried about NVIDIA just taking off because it already announced its earnings. It gives yourself some upside, and it actually brings in a small credit to the account. All right. If you have any questions, please do put them in the chat box, and we can try to address them. I'm going to take the screenshot of this. This trade I am actually going to put on in my account, in my retirement account where I have NVIDIA. I'm going to put this trade on as a covered position on, I'd say, half of my shares in NVIDIA. I don't think I'm going to do all of them, but I'm going to do them on at least half of the shares in NVIDIA. And that's the way that I'm going to approach the trade. So interesting week. Had a great show with Russell Rhodes on Monday. I do like the VIX trade, which makes me nervous because I do really like the VIX trade that we talked about. Russell gave me an A+. That was my grade for the trade on Wednesday. And if you want to check that out, please go check out that show. I actually sent it out on x.com. So there's a screen grab of the trade that we put on. Well, maybe I can put this one out there too, just so that we have a documented of it. But it's hard to explain because ideally you actually have the 100 shares of NVIDIA in your account. It's not that you're just putting this entire position on, but I guess you could. I mean, you could buy it and put on this front spread, the ratio front spread, if you'd like. And if you'd like to just see the front spread and the setup, go to optionsplaybook.com and use the search bar and type in front spread. That's it for this edition of Options Guide TV. We will be back on Monday at 11 a.m. Eastern time for the next edition of Options Guide TV. Hope to see you there.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.